As Chief Investment Officer at Smith & Howard Wealth Management, I get dozens of emails and calls weekly from firms attempting to sell their products. Those pitches run the gamut from simple cash strategies to private equity and Bitcoin derivatives. Most of what I see or hear isn't really new or worth exploring, but occasionally something will grab my attention. Offerings that do get my attention may still turn out to be something we aren't interested in, but they are at least worth getting a better understanding of. An example of that might be when we see several firms launching what I'll call copycat products. That's usually a good indication that something is different or gaining traction with the average investor. That's the case with what I want to talk about today. After a host of similar product launches by multiple firms, a Wall Street Journal article, and then subsequently getting a few emails from clients, I decided to take a closer look at structured or buffered exchange-traded funds, or ETFs. Before we can really get into that, I need to back up for a moment and talk about the product that preceded and led to the development of these new ETFs, structured notes. Well, they haven't always been accessible to the average investor. Structured notes have been around for decades. In short, they are fixed income-like securities, but returns are linked to what happens in other markets. Let's look at a simple example of a structured note and walk through its terms. In this case, JP Chase is the issuer. Like a bond, it has a maturity date, here 1 year. It's 100% principal protected, meaning that unless the issuer defaults, the investor at worst gets their initial investment back. Returns above the original investment are tied to the performance of the S&P 500. This note offers 100% upside participation, but only up to a 10% cap. So if the index rises 4%, the investor gets 4%. If it jumps 20%, the investor's return is capped at 10%. There are many other features and variations, but this gives you the basic idea. I'll be honest, I'm not a fan of structured notes. But to be fair, there are situations where they can make sense. For very risk-averse investors willing to cap upside in exchange for downside protection. Or when somebody otherwise would stay in cash and needs a nudge to get into or re-enter the market. If there's a known liquidity need, like taxes due in a year and cash or treasuries feels too conservative. Or lastly, for investors with a specific market view, like on commodities or niche indexes where a note makes implementation easier. Now that we've covered some of the basics on structured strategies, stick with me for our next video where I tell you all the reasons I think investors should generally avoid these strategies.